right, what's up guys? We are back with another market update video, and I'm here with Brandon Kelley from last time.
Hey guys.
So we're going to be chatting a little bit about the market, what we're seeing, and a lot of people are asking what's going to happen. Are we going to be fully into the ground like 2008? Personally, for me, I don't think it's going to get that bad for us. Rates have been going up. I believe they touched 6 not too long ago, and they bumped back down today.
Yeah, it's still a crazy environment where mortgage bond prices are up and down, and we could be looking at 6s one day, 5s the next. But I mean, as a trend, it's been going up.
Yeah,
it's been that way since January. We've just seen it climb and climb. I don't know that we're out of it quite yet, but yeah, that seems to be the trend right now. Is interest rates kind of on the up.
So we're assessing the data and we're trying to figure out how to best advise clients. And the hardest thing to do is to predict where the market is going, where rates are going, because that all implies of today's market too. If rates are expected to continue to go up to 8-10%, then yeah, this is a better time to buy than it is in 6 months. But as we saw an article come out that rates might be dropping to 4.5 next year by Fannie Mae, that's very interesting, because if that does happen, we know competition will pick back up. And a couple reasons we know that is because home values haven't changed much, but sales have dropped down 15 to 20% since last year in this month. So that's the interesting thing about where our market is. Home values aren't changing too much. So now we have higher home value and high rates. Buyers are pulling back, which makes sense. But what we're trying to do is justify if you were to purchase today and rates do drop next year, the best thing you can do is refinance next year and avoid the competition.
Yeah, so I think everybody, it's kind of like people have a really short memory. You know, it's kind of like everybody always wants to have something to be complaining about. They're always focusing on the negative. And I remind people, man, the spring was crazy. You were in it, I was dealing with it. It's like you've got every property you're looking at. It didn't matter if you were a good realtor or somebody that didn't know what they were doing when you're trying to get your clients a home. It was nuts. I mean, so many good realtors had to write 10 and 12 offers just to get a property under contract. You had, minutes in some cases, hours to decide whether or not you're going to write an offer on a property, where you're going to offer it. People were having to throw offers way above list price. It was mayhem. And so that was a terrible position to be in. If you're a buyer, that's not advantageous for you at all. You just have such little time to make decisions, and you really had to act quickly if you wanted property. So, we're in a different market now, and I still think it's a good time to buy. We're hearing, CNBC put out that article that I know you mentioned and referenced, that Fannie Mae had suggested rates come back down to around the 4.5% range by next year. This is something they've been suggesting for some time. That's a figure I heard months ago. It's one of those things that they're not just saying that, they're not just projecting that. Fannie Mae, for those of you that don't know, is the investor along with Freddie Mac for all conventional loans. Conventional loans make up I'd probably estimate anywhere from 80 to 90% of mortgages when you go to purchase a mortgage. And so when they're not just saying that with their projections, their actions would suggest that as well. So not to get too into the finite, minutia of it, but when they are pricing loans, when I go to write you a mortgage, we ultimately sell that mortgage to Fannie Mae and Freddie Mac if I do a conventional loan. And when they do that, the bank, the investors, pay us a flat fee. And for some time now, as rates continue to go up, they're paying less and less to our bank and to all other mortgage banks as bond prices get worse. And so that the amount that they're paying is less and less. The end consumer is having to pay essentially what are discount points every time they go to purchase a mortgage. And so we're now seeing it. We were seeing it first on investment properties. Those are the riskiest. Then we saw it on second homes. We're even seeing it in some cases on purchases for primary residences that consumers are having to pay upfront financing fees essentially to make up the cost, because the end investors do not want to have to fund these loans with the high interest rates. Why? Because they think that next year rates will come down. And if they do, they know that they just wrote you a loan. They gave you let's say $400,000 or $500,000, and ultimately you're going to refinance it next year. The only money that they make if they don't charge less and you ultimately get charged discount points, the only money they're going to make are your interest payments over that 6-month period. If you refinance in 6 months from now and you only made 6 interest payments, but they lend you $400,000 or $500,000, that's not a good investment for them.
Yeah.
So they're saying it publicly. We've caught wind of this for some time now, but they're not just saying it. It's kind of backed up by their actions and what they're charging when it comes to write a loan in that range.
Yeah, I mean, and that changes everything. If it does become true, that changes everything.
Yeah.
Because now we know it's going to get crazy competitive. And even for me, I lost out on multiple offers a week ago. And it was a home that had 3 homes in the neighborhood available. That home came up $20,000 under market value, and it went into multiples. And it shows that the demand is still there. So the only missing piece of the puzzle we have are rates.
Yeah.
So if rates are able to adjust a little bit, it's going to be a feeding frenzy again.
It will.
And
yeah.
we're seeing it. And it's just a matter, in my opinion, it's a matter of time, but it's all dependent on what's going to happen.
Yeah, I think we're going to be back in that buyer situation when rates come down. I don't think it's really a scenario where there's less buyer interest. I don't think it's a scenario of people have decided not to purchase. I think it's just that people watched interest rates go up. Really, the media ran with these rising rates for some time, scared a bunch of people out of the market, and people are just not sure. They're not necessarily in this case thinking strategically. It's just kind of in this emotional, afraid situation where rates keep going up and they don't know what to do.
Well, yeah, and if you guys, most of you follow me on social media, you're seeing I talk a little bit about commercial and how commercial investment has not stopped. I mean, Hillsborough Street is getting developed with 6 or 9 projects on there, and they're all submitting site plans. Commercial money is going aggressive right now, like it's always been.
Yeah.
But it's just the residential buyer has stepped back a little bit to see where rates are going to go. And there's always going to be something in the market. Last year everyone was like, this competition's insane, I'm going to wait till it cools down. The market has cooled down, but now you're dealing with rates. So really, if you're trying to buy and you can't decide, you really have to assess your situation. Now, if you're trying to buy as an investment, that might be a different scenario because your property might not cash flow at that point. But if this is you and this is going to be your personal home, assess your situation because the market's never going to be perfect. There's always going to be a con to the market.
Yeah.
And that's kind of our job. You do want to buy. Let's figure it out. Let's get you on the best vehicle there. So that's kind of what I tell my clients, and and Brandon really does a great job of explaining what your options are based on what next year is going to look like.
Yeah, and again, when it comes to these projections, they're projections. It's our best guess. Nobody knows. Nobody has a crystal ball, and obviously we can't know for sure what they're going to do. Clearly, Fannie Mae's actions suggest that they really strongly believe this. And another thing to look at that I think has a really good historical context for where we're at now and where rates probably go. There's a lot of word. The Fed came out and announced that we're in a growth recession. I don't know what that means, but I do take recession from that term. And if you look historically, every time there's been a recession in the past, rates have come down afterwards. If you look at the following 4 to 5 years after a recession, once that period ends, rates historically always come down. And in fact, they also rise right up to it. So in the short term, I do think rates increase. They probably will continue to go up. I've heard word and caught some wind, I don't know all the details to it, that we might see them drop this week just because of some data coming out. But leading up to recessions, rate rises, and it starts to rise more and more sharply right up to the point that we're in it. And once we're in it, the Fed decides to drop rates to encourage people to buy to get us out of the recession. Real estate tends to bring us out of recessions. And so, again, you'll likely see that's a big reason why rates go down likely to the range of maybe 4.5% by mid to the end of next year. I know you talked about it. It's good to see CNBC put out an article that you referenced in a previous video. Maybe we can put something up on the screen during this video. But we're starting to see the mainstream media support this and cover Fannie Mae's projections. But I've got some math that I did. Again, we can only guess at where they may be. But, it's worth considering and doing the math to determine does it make sense if you're in the position where you're looking at purchasing, but you're thinking, should I wait until rates come down? I've done the math hypothetically. I'd love to share it just to take a look at what that would look like if you decide to purchase now, where rates are at versus wait till next summer when they project rates coming down.
So if you want to write them up.
Let's take a look. Okay, so let's look at some numbers. So for in this example, we're going to assume a $300,000 loan that's using the minimum down payment of 5% on a home worth $320,000. Okay, so the actual value of the home is $320,000. Loan amount's $300,000. The difference in payment between getting a mortgage right now and getting a mortgage next summer, assuming Fannie Mae's projections are correct, is a delta of about $500 a month. Okay. Now, they're projecting 4.5% on average, and so that means part of the year we'll see interest rates actually lower than 4.5%. So we're going to assume that's right around summertime. It's in September now, so there's a 9-month difference between now and that time next year. So the total amount that you would spend between now and next summer in your monthly payment is around $4,500. When you go to refinance next year, because rates are lower, you're also going to incur an additional expense. Let's just call it about $4,500 on the high end, because we're using conservative numbers for what you're going to spend when you refinance it. So your total spend, if you get a mortgage now, is $9,000 more than you would spend if you waited. However, your home that you're putting offers on now is worth $320,000. Let's assume roughly a 5.5% appreciation. I think that's a pretty conservative market, especially here in the Triangle with where we're seeing home prices go for. But let's conservatively say this home appreciates by 5.5%. That home next year is going to be worth around $337,000. And that's a difference of around $17,000. So the difference in what you'll pay for the home next year is about $8,500 more than what you're going to spend additionally if you got a mortgage now. So the math really makes sense for you to go ahead and get a mortgage now versus waiting until next year. If you're renting, these numbers make that much more sense because you're throwing away that monthly payment every month. So again, these are projections. We don't know where they're going to go, but if they're correct, they would really strongly support going ahead and getting a mortgage now as opposed to waiting till next year when rates drop.
Wow, man, that's very interesting. So that's a huge amount that they should be considering when purchasing now versus next year, if that's what's going to happen. Also, another thing I wanted to talk about that I think those numbers were very conservative, especially what we saw last year with multiple offers, $30,000, $40,000 over asking.
Sure.
And if that happens again, that 337 price point, I think is conservative.
Yeah, I think there's a lot of wiggle room with those numbers. I mean, I really went with conservative numbers. I think 5.5% is probably low for desirable homes. I mean, there's a lot of wiggle room in there, especially when you factor in if you're renting. I mean, you're just throwing away those payments over the next 9 months. So that's just more money lost. Your opportunity cost is that much greater going ahead and moving forward on something now.
Well, even the home that they might be able to buy today is not going to be available next year.
Sure.
And homes in that area are automatically going to be more expensive if we see more buyers active in the market. Okay. So the opportunities we have today, they're just not going to be here next year. You might be getting better rates, but then you're also paying for it with price.
Sure.
So it seems like one way or another, guys, there's pros and cons to each market. So if you guys are interested in purchasing or wanting to refinance, please reach out to us. Both our information's below, and thank you so much.
Thanks, guys.